Good morning. It's Friday, March 20th. Here is what is on the agenda. Oil prices drop on US and Israeli reassurance. Short-end government bonds in focus on inflation concerns. And European leaders are getting anxious.
So, another day and another focus on the oil markets, of course. But today, a slightly different reaction function. Down 0.4% on Brent at 108, having crossed about $113 per barrel yesterday. So a little bit more reprieve on oil, at least for now. Let's see how temporary or sustained that is as both Israel and the US come out and try and reassure around the oil markets after the infrastructure attacks we've seen this week. Gold currently up 0.5%, but interestingly still on track potentially for its worst week in about 6 years, the yellow metal, and precisely to Anna's points, as traders start to bet in higher interest rates, higher for longer, and of course that detracts from the yellow metal. European futures pointed to gains of 0.5% after losses of almost 2.5% yesterday. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's just gone 7 o'clock here in London. Friday, the 20th of March. Friday, Tom. It has been an incredible week when it comes to volatility in markets, in particular in energy markets. This time yesterday, we were watching as gas prices flew out the gates, more than 20% to the upside. Today looks different. Today we have energy prices in retreat, not by a huge amount compared to yesterday's close, but the downward trajectory is interesting. And it comes in the context of US and Israeli reassurances. That's been the attempt. President Trump talking about not putting troops on the ground, also talking about this being over soon. President Netanyahu saying he's going to refrain from any attacks on the Iranian energy facilities. And all of that adds up to a little bit of weakness, at least at the margin, for these energy markets. It
is at the margin. European gas prices right now down 2.2% after the pop of 30% or so yesterday, 20 to 30% on European gas. So we're seeing a modest downside pressure in terms of gas today. And to your point, Brent and WTI also slightly softer. The time frame is really interesting because, to your point, the Israeli Prime Minister said this could be over quicker than many people expect. President Trump has outlined a window of between 4 to 6 weeks. But the costs are already mounting. Yeah. Qatar Energy says that their facilities, part of their facilities, could be out for up to 5 years at a cost of $20 billion per year. Would have supplied. So 17% of the LNG taken out as a result of that infrastructure hit. 5 years, potentially. You have the US, you have the Pentagon going to Congress and saying we need an additional $200 billion to continue to fund this war. Does that suggest that, in fact, they're gearing for a longer conflict? We don't know. But the costs are coming through, and certainly policymakers, whether it's the ECB or European leaders, are starting to react to this.
Yeah, absolutely. And it is interesting. You raised that point about the Pentagon and the Department of Defense in the States going to asking for more money from Congress. And, you know, how do we square that with President Trump saying that this will be over soon? They seem to perhaps point in different directions, or maybe one's just a contingency. In the meantime, we are continuing to ask questions. We've been doing this for weeks around 2022 comparisons. And from a European perspective, that's really important because 2022 was so painful economically. Politically, it set off all kinds of big shifts, geopolitical tectonic plates were on the move as a result of this. So what's really interesting is that oil prices have started to look like 2022, and the surge has been more than 2022 now. But gas prices haven't, and that probably from a European perspective still matters. Some comfort at the margin.
And there are those who are pointing out, including Javier Blas of Bloomberg Opinion, that we need to be focusing less on Brent and more on refined goods like diesel and jet fuel. And Europe is particularly vulnerable on that front. So really interesting. We hear from the ECB, and certainly they'll be looking at that 2022 playbook. Christine Lagarde saying we are in a better place. Rates are at 2%. They kept it on hold. Joachim Nagel in the last 30 minutes or so, of course, on the hawkish end of the spectrum from the German central bank, the Bundesbank, saying that April could be in play in terms of a rate hike from the ECB if the conditions continue to sour. But this was a hawkish pivot from the ECB yesterday, and it was a hawkish pivot from the BOE as well.
Absolutely, and this had global ramifications. It didn't play out to the States over the Atlantic as much as it did in Europe, as you might expect, but it certainly had a big impact on European bond markets. Gilt markets, if we look at what was happening at the short end of the curve across Europe, but particularly on gilts, up by 30 basis points on the 2-year in yesterday's session. BTP's up by 16 basis points. This was a really sharp repricing, even though we'd already repriced to some degree around the UK story. We'd taken out the expectation that we were going to get cuts, and suddenly the market went crazy pricing in hikes. The Bank of England suggesting that maybe the market got over its skis a little bit, and actually a number of the notes I was reading this morning suggest maybe something similar. So Berenberg saying it doesn't mean we're going to get a hike next, just means we're on a pause right now. I mean, we're leaning towards a hike maybe in the market's eyes, but let's steady on is what the message from Berenberg seems to be. BMO saying, look, the BOE's actually less hawkish than the sum of its parts. So for the first time, actually, or for I think nearly the first time, we got all the detailed commentary from all the individual voices at the Bank of England, and that added up to a lot of very hawkish language. But BMO suggesting that actually at the top level they're not quite as hawkish as some of those lines suggest. So once again, we are focused on higher energy prices, higher inflation expectations, and what that does to the front end of European bond markets.
It seems to be that there's a split between the economists and the traders on this front. Traders pricing in more than 2 hikes for the Bank of England. Our own in-house economists think they stay on hold, which underscores your point. But just to reflect and take a step back, we've gone in the last 3 weeks from pricing in 2 cuts from the BOE to potentially three hikes. The ECB, interestingly, coming out with a forecast on inflation, 2.6%, but they suggest that if this is a prolonged conflict, you could get above 6% on inflation. Above 6% is what they're forecasting if this is prolonged.
That's in their sort of really stressed scenario, isn't it? And important to say, as you say, that's not their base case. It also assumes no policy response. So it assumes nobody does anything to try and bring down that inflation. But it certainly, it got the headlines, it got the focus. If central banks in Europe yesterday had been trying to express seriousness and a focus on inflation, then they certainly did that, and the market was listening and then some.
EU leaders as well. So you have the central bank governors. So what are the policy tools that the EU leaders could be reaching for? Because this was central to the discussion yesterday as well. Yeah,
absolutely. And this is the context in which those European leaders are meeting. They've got higher energy prices, higher yields, inflation concerns back on the agenda, and stockpiles are less than they would averagely be at this time of year for Europe. So that does have a focus to it. It does bring a focus of mind. I mean, it's not cold, so that's, one good thing. But certainly there is anxiety amongst European leaders, and that's certainly what we saw being expressed. It's a reminder, these are some of the same leaders who went through 2022 and had to steer their economies through that huge spike in gas prices. And even though we lack the parallels, it is something that they are increasingly focused on. What I thought was also interesting is in a side meeting to what was happening in Brussels, there was a report issued where the Brussels sort of economic community saying, well, we're worrying about prices, but we're actually also worrying about supply. And that goes back to the point you were talking about. We're worrying about jet fuel, we're worrying about diesel, and where that takes us.
And the fiscal space is that much more narrow because of that spike in bond yields. And so the tools they have at their disposal, potentially including tax cuts on things like electricity bills, but that, of course, would lead to a fiscal hit. There's also some discussion, so 10 EU nations, including Italy and Poland, putting some pressure on the EU to change the emissions trading system, which puts a cost on carbon. That's not unanimous, but it is 10 nations. So those are some of the tools they're looking at, but all of them seem to come with some cost. Here in the UK, you're getting voices on the right saying drill, baby, drill. Over in Spain, they're saying let's focus on renewables. This is a reminder we know to our own domestic supplies, and we should use wind and solar. And that was the line from the Spanish Prime Minister yesterday.
Yeah, we will talk to BNEF a little bit later on in the programme about just that, the energy mix, implications of all of this. Let's tell you about some of the great conversations we have coming up on the programme. Nikos Christodoulides is the president of Cyprus. We'll be talking to Oliver Crook this morning. Really interested in the context of all of the stresses and strains that Europe is under right now, but also with the added dimension of the role that Cyprus plays for the UK military story. So we'll get his perspective there. Karim Chadiv will be joining us from BlackRock, EMEA Investment Strategy. We've had a lot to say about gold recently. What's his view? We've heard a lot about gold. What's his view? Robert Straiger will be with us, World Trade Organization chief economist. They put out a forecast really interesting about how global trade performs in the context of what's happening in the Persian Gulf. And Harriet Reeves will be with us from Starling, the chief information officer there, with something to say about AI in banking, but a broader conversation about the use of AI in the UK as well.
Here's what else you need to know this Friday morning. Sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jerome Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony that Powell gave to the Senate. Powell has denied the allegations, calling the investigation a pretext for pressuring the Fed to lower rates. President Trump joked about Pearl Harbor during his meeting with the Japanese Prime Minister at the White House. Trump offered the retort after he was asked by a reporter why the US had not informed allies in advance of his strike on Iran.
When we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? You know, he's asking me, no, you believe in surprise, I think much more so than us.
Alibaba and Tencent lost about $66 billion of market value in roughly 24 hours after the market punished the Chinese tech leaders for failing to lay out clear visions for how to profit from AI. Investors who had piled into the sector's biggest names over the past week, betting the advent of open claw-style AI agents would galvanize the industry, reversed course after Alibaba posted disappointing results with no clear path to monetization in sight.
Let's tell you what's coming up on the programme then. The consumer goods giant Unilever has confirmed just this morning it is in talks with McCormick of the United States after receiving an offer for its food business. It also says it's confident that this business could do well within Unilever, so we will get to that and the detail there. Plus, with natural gas prices spiking and LNG, a potential shortage of LNG on the horizon, we look at the implications for European energy markets. Up next, we will speak to Ole Hansen, who's the head of commodity strategy at Saxo Bank. Oil in focus, the Straits of Hormuz certainly in focus, and gas and gold, all of that in the mix. If you want to get involved in any of these conversations, IB plus BBT Vigo is the function on the Bloomberg terminal. This is Bloomberg.
Prime Minister Netanyahu about attacking the oil and gas fields.
Yeah, I did. I told him don't do that, and he won't do that. We didn't discuss. You know, we do. We're independent. We get along great. It's coordinated, but on occasion he'll do something, and if I don't like it, and so we're not doing that anymore.
President Trump talking there about the Middle East and the attacks on energy infrastructure, of course. Oil has declined after those comments from President Trump and also those from Benjamin Netanyahu of Israel, who also sought to ease concerns, at least from a energy perspective, vowing not to carry out any further strikes on Iranian energy facilities. Let's speak now to Bloomberg's Jumana Basechi, who's in Dubai. Jumana, President Trump and Netanyahu both then trying to de-escalate with that language around not hitting energy infrastructure. How is that being reflected on the ground?
Yeah, Anna, I'm going to rephrase part of that statement to trying to de-escalate part of the war. And specifically, you know, if we go back to the comments that were made by President Trump and Israeli Prime Minister overnight, President Trump still trying to distance himself from those airstrikes that Israel conducted on that Iranian gas field. And then yesterday in the press conference, the Israeli Prime Minister did say that they acted alone and that on the U.S.'s request, they will no longer target energy infrastructure. So those are the statements that came through. I should also say that the Iranian Foreign Minister Abbas actually put up a post saying that if their infrastructure gets hit one more time, they will show zero restraint, and that the retaliation so far has showcased just a limited part of their firepower. So still warnings coming through from Iran. So yes, an attempt perhaps to de-intensify one part of the war, but at the same time, the strikes and the counterstrikes continue throughout the course of the evening. IDF reporting massive airstrikes throughout central Tehran. It is the first day of the Eid for most countries in the region. The first day of the new year also for Iran, so a holiday, something to bear in mind too, but that hasn't let up the intensity. Iran have also been retaliating. We're just hearing this morning of another refinery strike that was targeted in Kuwait. We've heard of more interceptions coming through from Saudi Arabia in the eastern part of the country, in the northern part of the country. Over here in Dubai, once again, we had missile alert texts coming to us on our phones, the residents this morning, more interceptions overnight. And I think, from the perspective of everything that has happened over the last 24 hours, there probably has been a little bit too much emphasis on the flow of strikes as opposed to the full stock of what has happened. Qatar Energy putting up that communique in the middle of the night, suggesting that 17% of their capacity is now going to be taken off the market. It's going to take them years to recover from some of the damage that was sustained. You have two major gas fields in the UAE that were also taken offline. Continual hits at these refineries or targets at these refineries, which means that many of them have halted production. That accounts to about 2.5 million barrels a day. So in aggregate, there have been multiple strikes still at key energy infrastructure spots in the Middle East. And this is something that the region and the world are going to have to grapple with, not just for days, for as long as the conflict goes on, but even should the conflict or the war end tomorrow, possibly months and even years after that.
Jumana, thank you with that important update. Again, live, of course, from Dubai. Jumana Pasechi with that context and with that detail. Let's bring in Ole Hansen now, Head of Commodity Strategy at Saxo Bank. And Ole, good morning. I'll start with the picture that Jumana was outlining for us, which is a picture not just of supply constraint in the energy markets, but supply actually being taken off the table. Is crude pricing in that reality?
Good morning, Tom. I've struggled to see that we actually are, because this basically just all points to higher for longer. Even if there was a ceasefire tomorrow and the strait was reopened, we're hearing about these damages to infrastructure. We're also seeing shut-ins from wells that cannot just like turning on a tap in your kitchen. It will take time to get that supply back. So higher for longer seems to be the risk right now. And the question is, as you say, does a Brent crude price here just above $100 really reflect that properly? It may do, because obviously we at the same time seen this massive divergence in between refined products and Brent. So obviously the refineries are trying to get as much crude they can, but they're also obviously reaping very high rewards because the product market is as tight as it is, and that's really where we should continue to focus to get any sense of what the economic impact will be of this.
Where can the world turn to get those refined products now that much of that is shut out of the Middle East?
Well, that is the big question. Probably not really anywhere. I would say maybe apart from Russia, but that will make some. That will trigger some additional changes. Because right now we all know that the barrels that comes out of the ground in the Middle East is perfect for the middle distillates. That's really what we're missing right now. We cannot get that from the US, which is mostly gasoline. So we are incredibly dependent on the Middle East for this source of supply. Not only for the raw, for the crude oil, but clearly also for the refined products, which with the Middle East having become increasingly a refinery hub in the last decade.
Uli, you mentioned Russia. The US has obviously changed its sanction stance on Russia, at least in the short term, and in a very specific way related to the energy or the product that is on the water. We're now seeing a wider drawdown of some of that product that has been floating around on the water for quite a while. Are you factoring in a change in European stance with regards to Russia, or is that just a step too far, do you think?
I think that would be a step too far right now, but even the removal, potentially temporary removal of sanctions, is really just putting a small band-aid on a massive wound. It's not really going to heal anything. It may just ease a little bit of the tightness, but luckily we can say we came into this conflict with a massive amount of crude oil stored at sea, which can be shipped around, and we're seeing those inventories starting to come down. We're just waiting for the next weekly update, which you guys will put out sometime this morning from Vortexa, but that has helped alleviate some of the initial pressure. But as those barrels start to come onshore and be refined, then the question is really where are we going to find the next barrel from if this $10 million barrel a day disruption continues.
Yeah, we'll look for that then, Ule, that data on drawdown on the water. Can I ask about Brent versus WTI? Just in the last few days, we seem to have seen more of a divergence. It was certainly a story of yesterday. Then the White House said that they have no plans to stop exports of oil and gas. They said that would damage their producers. Are you factoring in a big divergence between these benchmarks?
Well, I would not have thought that we were at some point yesterday. We almost saw a $20 discrepancy between the two, really reflecting a market or a WTI market that had become dislocated to a certain extent. But at the same time, when we look at the refined products in the US, they did not indicate this big divergence. So obviously, once a crude oil barrel has been refined, it's just like gas. It's seeking the highest bidder, and that basically means that refined products will exit the US, and I think rightfully so. An export ban would equally hurt the US. So that seems to be off the table, and that is the reason why we're back down to around the $10 spread. But it's still elevated. But that's also to a certain extent reflecting the time it takes to transport, and also the quality of the US crude compared to the one in the North Sea, but especially in the Middle East.
Ole, when do you think crude does start reflecting the energy that's been taken off the table at this point? And are we getting closer to a point of demand destruction on prices?
We're probably not there yet, at least in the Western world. We are seeing destruction already starting to emerge in Asia, and that clearly is the hotspot for this crisis for now, because Asia has been the main buyer of Middle Eastern crude. But if the crude, as we start to see these inventory levels being brought down and the tightness start to emerge in the crude prices, then clearly it will have to be reflected in the price to go higher, and we are ultimately, if this war drags on and the barrels doesn't come back to the market, normally we're sitting here discussing disruption to the tune of a few 100,000 barrels impacting price. We are looking at a daily loss of 10 million barrels, so it will have an impact. And obviously we don't want to get to a 2022 situation like we had in Europe, where gas prices surged to a level that we simply had to kill demand in order to balance the book. That is not where we are right now, but that is clearly the risk if this continues and drags on for too long.
OK, let me ask you about those 2022 comparisons then, Ule. Is it safe to say that from an oil perspective, this is worse than 2022 already, but from a gas perspective, it is not? I mean, maybe I'm speaking there from a European standpoint, but would that be your assessment?
The 22 one was a European shock, simply because we were dependent on pipeline gas from Russia. Suddenly that disappeared, and we had to look elsewhere. Since then, obviously, the LNG import facilities has been ramped up. But the problem with that is now that we are now in a global competitive situation. So if we basically have to compete with Asia for gas, and we can say luckily it's happening at a time of year where demand is slowing down. But at the same time, we need to consider how to rebuild storage ahead of the next winter. And right now, the spot price is higher than the winter price, really reducing the incentive to store. But asking back to your question, and this is I'm sure by far a much bigger crisis than the one we had because the one in 22 was an isolated Europe event. This is a global one.
Ole, do you like gold at these levels?
I do, Tom. But I'm also not immune to the fact that we are seeing a very, very popular investment that is now being a little bit put to the sidelined. There's a lot of speculation as to what's driving it. No doubt that maybe some of the initial trigger has been the reduced rate cut expectations in the US, down from 3 to less than 1 now this year. But also the dollar, which has gained some strength. The yield curve is steepening a bit. That is weighing, but I think ultimately it has been a very popular investment. If you want to go a bit to the sideline, realize some cash, maybe not for margin calls, but just simply you're a bit nervous, you get out of some of your popular and most profitable positions. So the technical break below 5,000 was really the signal. We will stabilize sooner or later. The world has not become a better place.
Yeah, OK. Ule, thank you very much. Yes, liquidity plays into that, doesn't it? Ule Hansen, Commodity Strategy Head at Saxo Bank. Thank you very much for your time. Coming up, as the conflict in the Middle East divides the region further, we will speak to the president of Cyprus about Europe's response and the threat of Iranian strikes on his country. That interview is next. This is Bloomberg. Welcome back. This is the opening trade, 7:30 in London. So 30 minutes until cash equities open. And the futures picture certainly reflecting a very different oil picture this morning, also reflecting what we saw yesterday. I mean, Tom, we had European markets down by more than 2% by the close. All of the major markets in Europe reflected that kind of negativity. And so this futures picture, whilst it looks positive, doesn't really scratch the sides in terms of making up for the losses of yesterday. But it does reflect that we have a slightly more subdued oil picture, if you can call 108 handle on Brent.
And we're seeing that reflected on the bond markets as well, with some stability right now after the rout that we saw yesterday, with yields spiking higher across, of course, the Eurozone, the UK as well. So we'll check in on gilts at 8 a.m. But currently you're seeing, again, a bit of stability across the benchmarks in Europe after that sell-off yesterday. So the German 10-year yielding 2.95, largely unchanged. OET's over in France at 3.62, and BTPs, where you saw yields spiking again yesterday, currently stable. Yields down 2 basis points on the benchmark at 3.76.
OK, the European Union is bracing for a protracted energy price shock after Iran crippled a vital Qatari gas plant, raising the prospect of a potentially years-long supply crunch. Following talks in Brussels, EU leaders expressed anxiety at the darkening economic situation. Our chief Europe correspondent, Oliver Crook, is in Brussels for us with an important voice. Ollie.
That's right, and I'm here with the president of Cyprus, Nikos Christodoulides, who was there last night into the late hours of the evening. So thank you so much for joining us bright and early this morning, discussing all the major issues that are facing the European Union and Cyprus, and chiefly among them the Iran crisis, all the trickle-down effects. But Cyprus is in a unique position. It was directly affected, the only EU member state to have suffered a drone attack as a consequence of this war. How is that adapting your idea both of Cypriot sort of defense strategy as well as European policy?
First of all, we are part of the region. We are not involved in the war, in this crisis, in no way. You know, my country remains a stable, safe and operational, fully operational hub for business, investment and tourism. We know the region because of our geography, because of our diplomatic relations with all countries of the region. We don't know the region from textbooks, and this is very important. And we're bringing to the European Union the perspective of the region. What is important out of this crisis? We saw, for the first time, solidarity in action from the European Union. Greece, France, Italy, Netherlands, Spain immediately reacted to my request, and without triggering Article 42.7, we tested it, and we tested it successfully. So that was very important. It was something that we discussed last night, and we need to see, and probably we'll do it during the informal European Council Summit in Cyprus, how to give substance on Article 42.7. What we are going to do in case a member state triggers Article 42.7.
And I'd like to get your personal perspective, in addition, the perspective from the discussions in the room yesterday at the European Council meeting about what the EU and Europe's role is in the Straits of Hormuz, in this conflict with Iran. You said that you disagree with some comments suggesting that this is not a matter for the EU. There are some initiatives that are taking place and that the EU should have a role in those initiatives. What role should the EU have in the Straits of Hormuz in this conflict in Iran?
Before coming to Brussels, I was on the phone with all leaders from the countries of the region, the Gulf, the Middle East. The countries of the region, they are expecting the European Union. This is the neighborhood of the European Union. They're expecting an initiative from the European Union, or at least from those member states of the European Union that they have a special interest for the region. And I think we're discussing about the repercussions, the consequences of this unfortunate situation. We need to concentrate on how we de-escalate. And right now is a time for leadership and unity. And it's another opportunity also for the transatlantic relations. We need to work together, the European Union, the United States, the countries of the region, in order to present an initiative for the de-escalation of the situation.
And for you, those initiatives, is it a primarily diplomatic role that the Europeans would play, or are we also talking about potentially, as Emmanuel Macron has talked about, a potentially providing safe passages through the Straits after things have calmed down a little bit?
First of all, we need a diplomatic initiative to achieve ceasefire. All of us, all member states, the countries of the region, the United States, other countries other third countries, we have an incentive to achieve de-escalation. So we need to work together. We need to present something tangible on the table in order to achieve ceasefire, and then discuss all the other issues like the one you raised.
And I want to talk also about NATO membership and defense strategy for Cyprus. Of course, there is a blocking vote in NATO by Turkey. Does this sort of event put urgency on potentially finding some kind of political solution with Turkey? And in the absence of that, do you think that the Article 42.7 provides a strong enough framework in order to provide those kind of defense guarantees for Cyprus?
Let me say that if it was possible for Cyprus to join NATO tomorrow, no question about it, we are ready to apply. It is not possible, and we don't want to apply just to get the veto from Turkey. But I don't agree with my very good friend Mark Rutte with regard to the autonomy, the security and defense autonomy of the European Union. It is possible, and it was tested in Cyprus with the reaction that we had from the countries I mentioned before, that European defense and security, it is possible. And by having a strong European defense and security aspect, it's also helpful for NATO. It's also helpful for the United States. It's not something against NATO or against the United States.
I noticed that in the list of countries that you listed, which I believe was Greece, France, Spain, Italy, the Netherlands, what you failed to mention was the United Kingdom, whose bases were the primary source of the attack. Have you been satisfied with the UK's response? Do you think that the UK is paying their keep on Cyprus? You said going into the meeting yesterday, when the situation is over in the Middle East, we're going to have an open and frank discussion with the British government. What will that discussion include?
We have excellent relations with the UK government. Just to give you, an example to see how excellent our relations is, the Prime Minister visited Cyprus. It was the first ever visit after 53 years. We have a strategic dialogue with the UK. We're working very closely together, but the issue of the British bases need to discuss. I mean, all of us, we understand that the bases in Cyprus is a consequence of the colonial period in Cyprus. We have more than 10,000 Cypriot citizens in the British bases. We have responsibility for those people, for their safety, for their well-being. And when this situation is over, we need to have a frank, open discussion with the British government with regard to the future of bases.
In an approach and to that discussion, how do you think about those bases in terms of possibility of making Cyprus a target versus their asset as a sort of deterrence for Cyprus? Give us a little bit of sort of the flesh of the debate about that, because we have been protests, obviously, in Cyprus to kick these bases off.
As you know, in Cyprus we had a single incident targeted the British bases. Cyprus wasn't targeted. Cyprus is not part of this crisis. And of course, we don't like our country to be a target. So I had already a discussion with the Prime Minister with certain developments that we saw and we didn't like with the handling of this crisis. And when it's over, we need to put everything on the table and discuss and decide together for the future of the base. So just to labor on this point for just a moment, in 10 years from now, how do you imagine that relationship having changed? Would you like those bases to be there still? You know, it's not diplomatically correct to negotiate, from the studio. As I told you, I already mentioned some of my concerns to the Prime Minister, and when the situation is over, we'll discuss everything.
And I'd like to get your sort of appraisal of the economic impact of what we've been seeing in Iran. Obviously, we've heard from the ECB yesterday. We're talking about inflation potentially upwards of 6%. We're talking about potentially, huge consequences for growth. Do you have your arms around what the impact is going to be for Cyprus? Is it, what is the sort of risk of a, for example, recession in Europe?
All countries will be negatively influenced if the situation continues. And that is why I'm insisting on the need for de-escalation. If we don't de-escalate, we don't know how the situation will develop. And for sure, the repercussions are going to be serious in all aspects: economy, tourism, trade, energy, etc. So that is why we need to turn this crisis to an opportunity, work together, have a coalition, if I may say, of the willing, in order to present a plan and achieve de-escalation.
And another sort of consequence of the war in Iran is obviously a great concern with what the path forward is for Ukraine. Obviously, it funds the Russian war chest in addition to a great conflict that was yesterday on the 90 billion euro loan. I'd like to get from you just kind of an appraisal of the atmosphere in the room, particularly vis-a-vis Viktor Orban, and what you see as the path forward for that 90 billion euro loan.
Let me be clear that I don't agree with my very good friend Viktor and his stand on the 19 billion. We had a decision for the 19 billion on December European Council. And you can understand that the message that we are sending, if we have a decision at the level of the leaders, at the level of the European Council, and we don't deliver, it influences negatively our credibility as a European Union. I really believe that there are no deadlocks to diplomacy. We will find the way to implement what we have decided.
And also, over the weekend, we got an interview from Bart de Wever, the Prime Minister of Belgium, who is saying that it's time to basically normalize relations with Russia to regain access to oil and gas, while also not being naive about Putin, sort of a paradox within that. He sort of walked that back a little bit, but there's a more serious debate that underlies this, which is what the path forward is with the negotiations with Russia. Obviously, we're at a total standstill with the U.S.'s negotiating role while this war is going on in Iran. What do you see as the path forward? Because what de Wever would say is there is no new ideas, there's no political will to get the old ideas in place. What is the...
I discussed the issue yesterday with the Belgian Prime Minister. Look, all of us, we have specific thoughts on the way of approaching, how to approach Russia. What we need to do, we need to discuss this issue at the level of the 27, have a common approach and send a common message to Russia on the way forward. Because if we are publicly position, all 27 publicly position ourselves with regard to the issue of how we approach Russia, then this is negative for the European Union. So we need to have a discussion at the level of the European Council, have a common approach and follow this approach.
And a final question on the impact specifically on energy prices in Europe, but also for Cyprus. Cyprus, I believe, is 85% or thereabouts dependent on fossil fuels for energy generation. What specific measures is Cyprus considering to dull the impact that we've seen over the last couple of weeks? And at the European level, what needs to be done? Is it just tinkering around the ETS? Because some would say that that's sort of naive in terms of trying to tackle the scope of the impact here.
It's not only the ETS. We discussed yesterday a number of measures that we can take. Those measures should be tailor-made, targeted, and temporary in order to face the situation as it is right now. And that is why last night we decided that we will come back on the issue of energy during the European Council in June in order to evaluate the situation and see what we should do as a European Union. For sure, it should not be just the ETS.
Do you have an idea? Are we talking about potentially gas price caps? That's something that we talked about.
It is an option. Yeah. It is an option, but we need to take under consideration that each country it has a different energy mixture. So their approach to face the challenge, it will be difficult. It will not be unified for all 27.
Well, Nikos Christodoulides, thank you so much for your time this morning after that European Council in Brussels here in Brussels. That is the president of Cyprus on all the different issues that were discussed and principally what the EU's role is in resolution of this conflict in Iran and going forward.
Great conversation. Oliver Crook, Bloomberg's chief Europe correspondent in Brussels. Ollie, thank you. Meanwhile, the top central bankers in Europe and the UK have warned about the impact the Iran war could have on inflation and the rate path ahead.
The risks to the inflation outlook are tilted to the upside, especially in the near term. A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices than currently expected, raising euro area inflation further.
This is a very volatile situation. I think by the next time we meet, which will be, our next decision is at the end of April, a lot will have happened, and I can't predict what. None of us can predict what it will be. But it is a very volatile situation. So I would caution really against getting ahead of that position, which is we held this time.
BOE Governor, of course, Andrew Bailey, and ECB President Christine Lagarde speaking yesterday after both central banks held rates steady. We're going to discuss the rate outlook for central banks later in the show, so stay tuned for that analysis. This is Bloomberg.
Welcome back, everybody. Now, this week has been a wild one for investors as headlines from the conflict in Iran whipsawed energy markets. The conversation around 2022 comparisons for energy markets is still evolving as gas prices remain volatile. Also evolving, the outlook for the Strait of Hormuz and Europe's energy policy response. This is what our guests on the show this week had to say about the moves.
The parity trade in 2022 was really a balance of payment shock. And that was related to obviously huge rises in gas prices, massive rises in oil prices for a very prolonged period. We're not in that situation now. The longer this goes on, yeah, we could be. But it wouldn't be my base case.
Now, the magnitude of the crisis is less. But that doesn't mean it could be completely ignored. The focus will be on activity to see if that holds up in the face of higher energy prices or not, because you do have stimulus.
In 2025, wind and solar generated more electricity in Europe than all fossil sources together. So both the marginal pricing and the EU ETS is really supporting the long-term trend for renewable.
There is a role for the public and private sector to work together. I think making sure that we're complementing each other, so we're both working towards the same solution. When it comes to insurance, what's critical is that we keep the market open, we keep talking so that these solutions can be in place, so that insurance is not an inhibitor.
The winning strategy right now is take a little bit of profits on up days because the next day is down, add on those dips the next day, and unfortunately it's not like the taco trade of April on trade war. This is a real war, and you can't pivot from that as quickly because you need Iran to play ball. It's not just Trump's decision.
Joining us now with more on the markets, Bloomberg's Morwenna Coniam from our Bloomberg Markets Today blog, editor of that blog. Morwenna, good morning to you. So it's all about energy. Everything comes back to energy. Inflation expectations, bond market moves, volatility in all kinds of asset classes. It all comes back to energy. What are you watching?
Well, I think that today, I'm obviously watching, we've got Brent coming down again, which is encouraging, but I'm not very convinced that it's going to be sustained. I think we've still got all of the underlying causes of volatility, and I think volatility is really the word. We've seen so much shifting in directions this week, but overall the trajectory has been up, closing at sort of highs since 2022 yesterday. It's a really dramatic increase, and that is having a ripple effect across global markets, inflation expectations in particular, and that's now really being seen in pricing for central banks, which is having a big impact on other assets. But I think in terms of the energy prices themselves, I think there's not really clarity in terms of any sort of stability which would see a really sustained recovery. So I'm not optimistic that's going to be sustained over the weekend.
Yeah.
Bring us some optimism on the UK. Is there anything to say about the UK? I mean, UK gilts sold off aggressively, and more aggressively than their European counterparts yesterday. Yields shooting higher. Yeah. What is the picture for the UK right now?
I mean, it's not a good day. It's been a terrible week, in fact. But I mean, the 2-year yield rising about 40 basis points yesterday. Really quite phenomenal increase as traders are now pricing in 3 interest rate hikes from the Bank of England this year. A few weeks ago, we were expecting 2 cuts. So we've seen gilt yields rising a lot at the shorter end, but public deficit data this morning that was worse than expected for February. So before all this started, really could start to see that.
Worse, wasn't it?
Exactly, yeah, quite a big a difference to what was expected, and basically that's because they spent more, and that really isn't what we need to be seeing. I think we could start to see some of that gilt anxiety coming into the longer end of the curve as well, because you start to get the sense of political risk, and what is the government going to do about the sort of energy shock that when we come out of the price cap in July, they are going to have to take some action, and the gilt market historically has not liked that at all.
From other European leaders, we heard from Christine Lagarde, we just heard from the Cypriot president, that any response has to be targeted, but we'll see what the UK context brings. On gold, I guess you're watching that just like everybody else. We've had a lot of conversations about whether this is still a haven on this programme.
Yeah, well, it's not behaving like a haven at all anymore, and that's mainly because as central banks globally are expected to become more hawkish. We've had, even rate cuts priced out from the Fed. That takes away quite a lot of its appeal, and we're also seeing metals more broadly hit by the destruction of demand, and that's a real concern for commodities. And I think gold is following suit at the moment. Just losing its haven appeal.
Morwenna, thank you very much indeed with that update. Morwenna Coniam, Bloomberg Markets Today editor. Let's get your stocks to watch with Charlie Wells. Charlie.
Good morning, Tom. So the first question that I have is, are these airlines, these European carriers, going to get any relief? Because we've been hearing so much about that oil price from the Middle East. You see so much red here for EasyJet, for TUI, for Ryanair, for Lufthansa. And their executives have been talking about how they have little wiggle room here, how they might have to start passing on a lot of these costs to consumers. So you can see the CEO of Lufthansa talking about how their average profit, the average profit for their company, is about 10 euros per passenger. So not a lot of wiggle room there. Do we see a floor there, though? Let's turn to luxury now, because they've also really been struggling. They've been struggling on the uncertainty from the Middle East. But also, if you look at the share price over the course of the past few, just really yesterday, you see a big decline here. And that is, in a way, some sort of a rate story, sort of a wealth effect story, as a lot of these asset-sensitive luxury consumers start to feel less rich. And then let's end with Unilever. Watching that, because we have that news about McCormick, Unilever confirming McCormick making an inbound offer for their food unit. Investors haven't liked this so far. Does that inbound offer turn things around? I want to see very soon.
Charlie, thank you very much. Bloomberg's Charlie Wells with some of the stocks in focus. Certainly another day of watching Unilever then, Tom. We got some response to the reporting around that story from our colleagues in yesterday's session, but we'll see if we get some more today. Today's session is just going to be a kind of reaction to yesterday, isn't it? We are expecting overall markets to bounce a little bit, but not to make up for the losses of yesterday.
It doesn't seem that this can be sustained in the long term. We'll see. It's very modest in terms of the downward pressure on gas prices, downward pressure on oil prices. But speaking to Ola Hansen, his view is there has to be more priced in when it comes to crude. So that could be more volatility in the pipeline. But given the sell-off that we saw yesterday, particularly in the bond markets and the equity markets, if you're down 2.4%, we'll see how the changes reflect, of course. European futures pointing higher right now as we look to the session, pointing higher by about 1%. The opening trade is up next. This is Bloomberg.
Welcome back to the opening trade. It's Friday, everybody. A few minutes to go until we get the start of cash equities trading. So this is the picture on US stocks from yesterday. You can see that European markets closed up, which is that yellow line, around session lows for US stocks. So we do have a little bit of upside to price in from that US session. Through the latter part of the session, we started to get more of that messaging from the Trump administration, from Benjamin Netanyahu. Both of those over the past 24 hours have been talking in slightly more reassuring terms, at least about the extent to which they intend or not to target energy infrastructure. And that has relieved some of the pressure when it comes to energy prices. We see oil prices slightly in retreat, gas prices slightly in retreat. And as a result of that, we saw a little bit more risk appetite for stocks. So we look, Tom, to see that at the start of trade. The futures picture does look positive then. We could be up by 0.9% on the DAX. So that's encouraging. But we, of course, lost more than 2% on most of these markets in yesterday's session.
In terms of individual names and sectors that we are focused on today, there was one sector that is in positive territory yesterday. That was the energy space. We'll see how that changes and adapts on the back of softer Brent and WTI prices, at least for now. Gas prices also falling a couple of percent in the session, so not significant, but we'll see if that reflects across the energy stock space that again did outperform yesterday. Unilever in focus on an update in terms of its potential sale of its food assets, so we keep an eye on Unilever. This is a story we've been reporting around. And postal stocks on an upgrade in terms of the view from FedEx and whether or not there's a read across there. That stock jumped almost double digits in the US session. We'll see if the likes of DHL move on the back of that story, Anna.
Yeah, it's interesting. The middle of this week, we started to ask questions about whether markets could decouple from the headline risk around energy assets in the Middle East. Well, the answer later in the week was certainly no. And yesterday, we got that message firmly. Energy stocks were the only sector in Europe in positive territory. Everything else was down, and we were down by more than 2% on these major bourses across Europe. So today looks like just a bounce from some of that negativity. How positive will we be today? What extent will we see that bounce coming through is really the only question. The FTSE 100 is up by 0.4%, waiting to see if we get some better gains from some of the markets that maybe have lost a bit more ground. The DAX, the CAC, for example, the IBEX over in Spain as well. So those markets a little slow to open this morning, but we are seeing a bit of positivity being reflected on that FTSE 100. And yes, we've got the CAC open and up by 0.8%. The IBEX up by more than 1%. So in some of these markets where we've seen more heavy selling, we are seeing some of those gains coming in. The energy sector was the only positive sector yesterday, as I mentioned. mentioned, Tom, basic resources was the only was the worst performing sector. And so it was interesting to see those two polarize. And today we see a lot of moving parts when it comes to energy prices and underlying commodities. So I wonder what the sector picture looks like today.
Top of the list is basic resources right now, up 1.6%, given the upside we've seen in prices around iron ore, around copper, around gold in today's session, of course. So reversing, at least to some extent, the losses that we saw across basic resources yesterday. So basic resources at the top of the list across your sectors. In fact, now it's travel and leisure. 1.5% for travel and leisure is the gain. Construction is up 1.5% and basic resources also around 1.5%. So they're all tussling for the top spot right now. On the downside, just one sector in negative territory. Not surprising to see that it's energy down 0.8%, given that we're seeing a little bit of pressure again on Brent and WTI today. So energy is currently down 0.8% after being the best performing sector, the only sector in positive territory yesterday. Again, basic resources, travel and construction in positive territory, gains of around 1.5%, Anna.
It's like someone's put a mirror up against yesterday's session and worked out the opposite. And that's what we seem to have today. So as you point out, basic resources doing well, energy stocks doing less so. We still don't have the DAX open, but we do see broad positivity across these stocks, but not making up for yesterday. Stock 600 up by 0.7%. Individual movers then, and Tom, you were talking about those postal stocks. Deutsche Post is one of those. It's up by 2.5%. We had numbers out of FedEx, of course. Prosus is up by 1.8%. That's often moving around on what's happening with its Tencent stake, and there's been a lot of news on Chinese tech of late. Some of it hasn't necessarily cut through into the show as much as it should have done because we've been too busy talking about the Persian Gulf, but we will certainly return to those tech themes in our next conversation. We are joined now by Karim Shadid, who is head of EMEA investment strategy at BlackRock, with us this morning. Karim, nice to have you with us, joining us from Paris, I think, today. I wonder, as we bring, I was going to say bring to a close, but there's still a whole day of trading left, isn't there? But we're in the last day of trading of what has been an incredibly volatile week. Do client conversations that you're having, Karim, as you travel around Europe, do they look like, are they all about defensive moves? Are they all about trying to find havens, trying to find safety? Is that where investors are, where their thoughts are going at this time?
Actually, yes, thank you. Really happy to join you from Paris today at the end of a roadshow, speaking to a lot of our clients across the continent. And actually, to your point, there's a spread in the conversations. On the one hand, when we look at the polls that we've been running on of our clients, of about 1,200 to 300 clients per week in these polls, in this time series of data, we are seeing that the bull minus bear, so kind of the net bullishness, is at the weakest in terms of sentiment since February 2025, based on our measures. So there has been a deterioration in sentiment around markets. But then when we look at the flows, we don't see that sort of capitulation in risk. There's been some de-risking this week, but it's by no means matching this sort of big risk-off moves in asset allocation. In fact, what's interesting is we're seeing a lot of interest come back into tech, into AI. A lot of the conversations this week have been about the AI theme, how to invest in AI, with AI, and why, as the market attention shifts away from these types of concerns around circular financing last month and late last year, to back to the fundamentals. Why bringing attention back to the fundamentals and the really strong earnings picture and the breadth of the earnings picture really brings back focus on this opportunity.
It's interesting, Karim, you mentioned that, because you can draw a line between what's happening in the Middle East and threats to AI. And I'm thinking here about the cost of energy. Energy is a big component of what AI businesses are trying to do. They need a lot of energy to do it. And also, Tom was making this point yesterday, that there could be threats to the amount of investment dollars available to invest in some of these AI projects if some wealthy nations in the Middle East aren't making quite as much as they used to. Are investors saying it's too early to join those dots, or they just don't expect the link to be that great? What's your thinking?
There's definitely a link on the energy front, and I think one of the key themes investors and clients are talking to us about is this idea of energy resilience and the energy continuum, right? As the build out of AI happens, and the big power demand theme that you're alluding to is super important here. This idea that you need all parts of energy. I come back to a theme that I've spoken about with you before in previous interviews around sustainable energy, and why the performance had come back to that space in May last year, and has and very much linked to this power demand theme. But then also traditional energy is very much in focus. You were talking about some of the near-term volatility in the sector yesterday, a very strong day. Today, seeming a bit weaker. But if we zoom out, there is an opportunity across the energy continuum. The refiners, for example, are really, really important in this space. Margins are looking better across the whole energy continuum here.
Karim, Europe is often flagged as a place where you can find some of the players that feed into the energy piece when it comes to supplying and supporting data center build out. What are you seeing in terms of US demand for European equities at this point? You're not seeing capitulation across these markets, but are the US starting to capitulate on Europe?
So you were talking about mirror images earlier, and one other mirror image you'd see is, in Jan and Feb, Europe and EM stocks have been significantly outperforming the US. And then you look at March, and it's exact mirror. A lot of the momentum plays in Jan and Feb have reversed in March. And that's in equities, that's across asset classes. You'll see that partly why gold has also underperformed in March. Anything that did super well earlier in the year is unwinding a bit in March. And here it's important to distinguish the fundamentals from what's just a momentum unwind. And to your point, bringing it back to Europe, we are still seeing demand inflows. They have not dropped off completely. Domestic demand for European equities remains very, very strong. Is definitely still there in March, despite some of that performance unwind. Understandable why the performance picture looked the way it does. Europe is potentially could see some inflation shock if the shock in the Middle East sustains, depending where the oil price rests. Of course, the forecasts here are very much a moving target because all it depends on is the duration of the supply disruption and where the oil price ultimately rests. If the oil price drops back down, you could see a bounce back pretty quickly. But all this to say, we are still seeing domestic demand for European equities. International demand waned a bit, but it hasn't turned into selling.
Where do you think the earnings vulnerability is going to be most acute for European stocks in the face of higher rates and higher energy prices?
So here we still look at the selectivity message in Europe. We really think that sector selectivity and single stock selectivity, the active approach in European equities makes a ton of sense. A value approach in Europe probably still pays off if the cycle continues. This is assuming that the cycle is not disrupted by the supply disruption. You might see some revision down in growth, some revision up in inflation. We're looking at about 0.5% magnitude here if the oil price sustains. But then you can still see these types of value approaches make sense in European equities. The sectors that we've been focusing on, whether it's in the industrial space, whether it's in the financial space, remain the favored areas to access Europe, whereas the consumer, to your point about vulnerability, consumer-facing sectors could be a bit more vulnerable.
Karim, it's interesting that you say in your conversations with investors that some of the themes that go back to before the Iran war started are cutting through around AI, for example. Investors were also worried back then and continue to be so about private credit. I saw one story yesterday that suggested that private credit investors or credit investors broadly are more concerned about trying to find cockroaches, areas of vulnerability, and business models to be nervous about than they are about the spillover effects from the Iran war. Maybe it's just a question of time, but what are credit investors thinking about, do you think?
I would say that we have seen some caution, but not panic. And there's a big distinction here. There is this sort of cautious hat that investors are wearing, whether in equities or in credit, looking for potential risks on the dashboard. But we are not seeing any sign of panic. We're not seeing any, flight to safety by any stretch of the imagination. In credit, the big theme for us going into this year that still stands is this idea of carry. This idea of, yes, you might see some spread widening here and there during weeks of risk off. And we saw that, in parts of high yield and credit more broadly in the past couple of weeks. And we have seen some clients, we talk to bring down the risk, from high yield exposures a bit, bring it down to neutral or maybe just below neutral. But we are generally seeing this mindset of continuing to carry credit with the idea that all-in yields can compensate you for mild spread widening.
I wonder what the linkages are between credit and gold. You still like gold, Karim, as a hedge, as a geopolitical hedge, really?
Yeah, so that's a call that obviously hasn't looked great in March. I stand by that, but when we look at gold, we really need to zoom out and think of the bigger picture. Some of the structural drivers of gold, such as purchases from central banks in emerging markets, which can be a bit price sensitive. So we saw a bit of a pullback in that data in February. We expect, we're starting to see signs of that come back in March because it is a bit price sensitive. So on dips, those types of purchases provide a bit of a floor on the gold price. When we zoom out, gold is still looking quite lowly correlated versus stocks and bonds on a 10-year basis, sub 0.1. Clients we speak with are very much still asking for gold and about gold. In the polls that we run, gold has constantly come through in the top 3 net add exposures when asking about asset allocation shifts.
Okay, on the case for gold. Karim Jadid, head of EMEA Investment Strategy at BlackRock. Always appreciate your insights across these markets, Karim. Thank you. Let's get you a touch and a picture on the Core 6 right now. 11, 12 minutes into the Friday session, and you're seeing broadly across the Core 6 gains, apart from Novo, which is essentially flat. The strongest upside currently coming through for ASML in the tech space, of course, up 1.6%. Similar gains for Schneider Electric. Talking of those European companies that play into the data center story and the energy story. In the defense space, Ryan Martel popping 1.2%, so a decent gain there for a stock, of course, that's rallied in the last 2 years substantially. LVMH, which has seen some pressure given the luxury story in the Middle East, 1.4% is the gain, actually, for LVMH. So that is the picture across the Core 6. Let's get some details on some of the other individual stocks on the move this Friday, bringing Charlie Wells. Charlie.
Good morning, Tom. So let's kick off with airlines because they are in the green this morning, flipping from being in the red yesterday. So up well into the twos for EasyJet, TUI, and IAG. Now, this could be some dip buying. This could be traders saying basically that they buy the narrative that the White House wants to try to take some pressure off of the oil situation right now. So again, seeing positivity here, even despite some pessimistic comments coming from a lot of executives yesterday about having to push prices on to consumers. Let's flip and let's talk about Infineon. This is the German chip company. What we're seeing here is also a lot of positivity, well over 5%. And this has been another theme of the week, right? That AI narrative coming back, giving a boost to a lot of these chip companies, particularly here in Europe. So Infineon up right now, well over 5%. Different story when you take a look at Smiths. Let's bring up Smiths, that British engineering company, onto the screen, down over 4%. So they had an earnings report out today. Clearly, that disappointed the market. They were talking about returning over 1.5 billion pounds or 1.5 billion pounds to shareholders, but the market not liking this. This could be uncertainty right now. This could be a little bit of that rate issue, a little bit of the hawkishness spilling in to some of these engineering companies. So we're going to want to watch that for the rest of the day. I am watching with great interest this next one. It is JD Wetherspoon's, down over 8%, almost 9% here, because I love a pub. I think we all do, particularly on a Friday, and particularly after a week like this. They also had an earnings report out that was disappointing, clearly talking about that consumer that's under pressure. Now, JD Wetherspoon's, of course, they talk about offering pints at reasonable or sensible, if I believe. I've spent enough time in those pubs, sensible prices. But when you have those thin margins, when you get this uncertainty, when you get a lot of this pressure on the consumer, you get pressure on the likes of JD Wetherspoon's as well.
We all love a pub. I'm just checking out to see whether the Jon Snow in Soho is a Wetherspoons. I thought it was. Anyway, we all love a pub on a Friday, particularly, as you say, Charlie, after a week like the week that we've just had. Charlie Wells with the stocks on the move this Friday. Thank you. Coming in and coming up, we're going to check back in on energy prices. You're seeing European gas a little weaker, just by around 1% right now on Dutch gas futures. Brent is trading down 1.4% at 107 after, of course, breaking through about $113 per barrel yesterday. WTI at $93 a barrel. So that spread continues, of course, between the two markers on oil. Currently down 2% on WTI. We'll see how sustained this is as Trump and Netanyahu try to reassure around energy infrastructure. We'll get more details and more conversation, of course, around that. We'll get an update live from Dubai. We'll have plenty more on that evolving story. Stay with us. This is Bloomberg. Welcome back to the opening trade. We are 18 minutes into today's session. Broadly, you can see, of course, gains across the benchmarks. The index over in Germany, the DAX is actually outperforming, up 1.4% across your sectors. Construction at the top of the list. Energy seeing a bit of pressure as a sector, currently down 0.4%, Anna.
European gas prices are lower and oil has dropped from its highest close since July 2022 as leaders from the US and Israel sought to reassure energy investors rattled by damage to major Persian Gulf energy facilities. Bloomberg's Jumana Pasecci is in Dubai and joins us now. Jumana, bring us up to date with the actual damage then that we've seen to Qatar's LNG plant. I know there have been strikes on facilities in Kuwait as well.
Yeah, absolutely, Anna. So a big strike took place at the Ras Laffan facility yesterday, as we spoke about. And over the course of the evening, Qatar Energy put out a statement defining how much damage they had been sustained. And what they did tell the market is that 2 out of their 14 LNG trains had been damaged. That represents about 17% of Qatar's LNG exports. And that the damage itself will take 3 to 5 years to repair. It's equivalent to about $20 billion in foregone annual revenue, and will likely to force them into a long-term force majeure with many of those customers. And you will remember that at the beginning of this war, they also announced a force majeure with some of their customers on some of those shorter-term contracts amounting to around $17 billion. But this just takes it to a whole new level because it suggests that this is going to take not months, but years to fully get back to the capacity that was targeted in yesterday's strikes, and not just affecting LNG, it affects condensates, LPG, helium, all of those other gases that are related as well. I should also say that in the UAE, this is getting less attention, but still very significant. 2 main gas facilities also targeted yesterday. Now, there were successful interceptions, but they've also halted production. That amounts to about 75% of the gas processing that's coming out of the UAE. So we continue to see these supply constrictions coming through from this part of the world. And then, to your point, Anna, overnight, more attacks on refineries. Second day in the row that a refinery in Kuwait has been targeted. They've announced that they've halted production too. And so if you list all of the refineries that have been targeted since the beginning of the war till now, you're looking at about 2.5 million worth of refining capacity. Now, most of these refineries have not sustained extensive damage like the LNG facility has in Qatar, but they have halted production, which just adds another dimension to the supply disruptions that we're seeing.
Yeah, and to some, of course, casting our eye back one or 2 days, Jumana, Israel kind of crossed that Rubicon in terms of its attack on the Iranian gas facilities. We've been hearing from the Israeli Prime Minister, Netanyahu, there's been an attempt at de-escalation from both Trump and Netanyahu, particularly when it comes to energy infrastructure. What have we been hearing from the Israeli leader?
Yeah, I would say specifically de-escalating one specific part of the war, which was the Israeli attacks on that South gas part field in Iran, deemed to have crossed the line. President Trump very clearly was trying to distance himself from it, even though there were various reports suggesting that the U.S. would have been privy to the information beforehand. And then yesterday, we did see official commentary from the Israeli Prime Minister. He gave a press conference and said that Israel had acted alone. They were not acting in conjunction with the U.S. And at President Trump's request, they have said that they will no longer be targeting Iranian energy infrastructure. But that is not to say that the intensity of the strikes have diminished, because the ongoing operations, the joint military operations, have continued overnight. Reports of very heavy airstrikes over central Tehran. And as I was just saying to you, Iran continues to lash back at Gulf states with these volley of attacks coming through on multiple countries and not just exclusively directed at Israel.
Jumana, thank you. Jumana Pasecci in Dubai. Meanwhile, the commodity market's view on the financial impact of the Iran war is more bearishly than that of the equity and rates markets. That's according to Simon White, macro strategist for Bloomberg Markets Live and author of the Macroscope column. He joins us now. Simon, we're seeing a modest reprieve in Brent and European gas today. Is that telling the full story? Is a protracted energy crunch being accurately reflected across other asset classes?
The short answer is I don't think so. I think that when you get energy shocks, it's not only how long they last for in real time, It's how long they last for over a longer period. So the longer they last for, the longer they take to remedy. So when, for instance, refineries are powered down, or when gas plants, liquefaction plants are powered down, they take a long time to power back up again. So you have these kind of what economists call hysteresis effects. That means that you just can't suddenly switch things back on again. So I think that the financial asset markets are not pricing in that longer-term impact that commodity traders already see. If you look at, for instance, break-even rates, inflation break-even rates, or CPI fixing swap rates, certainly in the US, they're still pricing a temporary inflation shock. So I think there's a mismatch there between the markets.
OK, so if you think there's a mismatch in the different asset classes then, Simon, and you think maybe commodity markets are taking this more seriously, other assets a bit more complacent, do you think it was sensible then that short-end yields globally, but in particular in the UK, jumped as much as they did yesterday, or did you think that was overdone?
I mean, that was quite a dramatic move. If you're ever going to see a dramatic move, it'll be in the short sterling and the UK rates. Look, I think there was a realization there that the Bank of England, obviously the Bank of England and the ECB are more inflation targeting banks, and they are not expected to have an incoming, chair like Kevin Warsh in the US, who's perhaps going to be more beholden to the government. So there's a lot more kind of freedom to move there. I think the dramatic move, like the size of the move, the extremeness of the move in the UK was kind of probably a stop out as much as anything else. But I think underlying it, there's a real understanding that the Bank of England acknowledged the fact that second round effects, inflation effects, are likely to come through. And then, of course, central banks, they say they won't act against what they see as a supply shock, but they will act against what they see as inflation becoming embedded. So that was kind of the penny dropping. So although the move was quite perhaps kind of over the top on a short-term basis, the underlying kind of sentiment behind it, I think was correct. So, that this is something that's going to be an issue for central banks. It's complicated in the US, of course, just as I say, because the incoming Fed governor is maybe not necessarily expected going to be an inflation fighter.
Thank you so much, Simon. Thanks for bringing us your perspective. Simon White, macro strategist for Bloomberg Markets Live and author of the Macro Scope column. And it's interesting, he, like many others, saying, maybe that was an overdone move on short-end gilts yesterday. But we're not seeing it unwind hugely today. We're seeing those gilt yields. They were up 30 basis points yesterday, 2-year, down 3 now. So there's a bit of move back, but not much.
And possibly there is less to unwind given what we've seen with the deficit as well. So the latest deficit figures coming in higher than many had expected. So that's another constraint for the UK.
Let's talk about trade. Robert Straiger will be joining us shortly, chief economist at the World Trade Organization. He tells us about the state of global trade with everything that's happening in the Middle East in mind, of course. That interview next. This is Bloomberg. This is the opening trade Friday morning, 30 minutes into Friday's cash equity session here in Europe. And European equity markets look like they're reversing some of the trends of yesterday. We were down by more than 2% on some of the major markets in yesterday's session. Ongoing concerns about elevated, higher energy prices, energy supply as well. But today we put those to one side. We're slightly reassured, at least from an energy perspective, by some of the commentary coming out of the US and Israeli administration. Energy prices are a little bit weaker, and so we see stocks go higher. We're up by 1% on some of these markets, the Xetra DAX in particular getting some decent gains. So, Tom, we changed course, reverse path on some of the moves of yesterday, but we're still very much focused on everything energy.
And it's quite broad-based in terms of the gains that we're seeing yesterday. But again, to your point, in the context of a drop of more than 2% by the close for European stocks yesterday. But again, quite broad-based in terms of the modest lift. We'll see how sustained that is in the days ahead for European stocks. Right now, you have about 500 individual names across the stock 600 in positive territory, and as you can see, about 88, close to 90 just in negative territory. Volumes are relatively light versus the 20-day average, or on par with the 20-day average. Not a huge amount to talk about there. When it comes to the leaders and laggards, let's break it down for you then. On the leaders side, Interestingly, tech is getting a lift today. That's one of the best performing sectors. Infineon upgraded by JP Morgan. That's had a ripple effect across the tech space. So that is up 5.4%. ASML also getting a lift as well, of course. The Dutch maker of those lithography machines, up 1.2% so far for ASML. A big weighting across the stock 600. And Santander, the banking space, is also gaining as well. A bit of a sell-off, bit of a pronounced sell-off across banks yesterday. So maybe making up for some of those losses. Santander currently up 2.3%. On the downside, energy names. Again, a bit of a mirror image, a reversal in terms of what we saw yesterday in the session, where energy was the only sector in positive territory. Today, it is on the downside, of course, on weaker oil prices, at least for now. Brent, BP then, under a little bit of pressure, down 2.4%. But again, in the context of the gains that have come through for these energy majors, Shell is down 1.4%. And Smiths Group falling 5.3%. That is a different story, unrelated, of course, to what's happening in the energy space. But this is where your attention should still be, is on what's happening around energy and how that's rippling across, of course, these various asset classes, Anna.
Tom, so that's the markets. Let's get up to date on some of the other stories that we are focused on this morning. The Financial Times is reporting that JP Morgan has started a monitoring program to guard against overwork by its junior investment bankers. The program will track bankers' weekly digital footprint, including video calls, desktop keystrokes, and scheduled meetings. Bloomberg has learned that Blackstone's flagship private credit fund is planning to sell bonds backed by its over $82 billion of assets. BCred, the world's largest business development company, is looking to finalise the collateralised loan obligation deal, or CLO, early next week. The Blackstone fund earlier this month took the unusual step of asking some of its senior lenders to pitch in $150 million to help fund elevated redemption requests rather than cap investor withdrawals like some of its private credit peers. And the European Central Bank will need to consider hiking interest rates as soon as next month, that's April, if price pressures build further due to the Iran war. This is according to the Governing Council member Joachim Nagel. The ECB's new projections show consumer prices will advance in the euro area this year, and in an extreme scenario, inflation could peak in the first quarter of 2027. So April, perhaps, from an ECB perspective, Tom, is a live meeting.
Yeah, 2.6% is the renewed target, or at least forecast, not target. The target's 2%. The forecast is now 2.6% for inflation. But, of course, in worst-case scenarios, they're looking at potentially 6%, the ECB. Again, that's in the worst-case scenario. Now, global merchandise trade will decelerate less sharply this year than the World Trade Organization predicted 6 months ago. But if the war in the Middle East continues, keeping energy prices high, then a deeper slowdown could take hold. For more, we are very pleased to say we're joined by Robert Straiger, Chief Economist at the World Trade Organization. Robert, good morning. What an important time to get your take on the health of this global economy and, of course, that focus on trade. What assumptions are you making right now about the impacts that the war in Iran is having on global trade?
Good morning, and happy to be here. As you mentioned, even before the outbreak of the Middle East conflict, we were predicting that merchandise trade at a global level would growth would fall from its 4.6% rate in 2025 down to a 1.9% rate in 2026, and we are expecting that because of the Middle East conflict, if it leads to elevated energy prices throughout the year, that could shave another 0.5% of growth off of merchandise trade. So the growth rate would be 1.4% that we're predicting in 2026.
Are you assuming that there's going to be, how do you factor in a scenario where this becomes more prolonged, where it's much more difficult to get these energy assets back into play? We're looking at the Qataris, for example, with an outage maybe of 3 to 5 years for part of their gas infrastructure. Do we need to start to think about what a longer term disruption means, even if hostilities end?
Our baseline forecast scenario that predicted a 1.9% growth in merchandise trade in 2026 reflected a tug of war of several factors that were important in boosting trade in 2025 and led to a diminished trade growth in 2026 due to the fact that these factors are no longer likely to be quite such a boost to trade. Beyond that, the question about the duration of the elevated prices from the war, we have assumed in our conflict scenario that prices of oil and prices of natural gas stay at their March 10 level. That's $90 per barrel for oil and $16 per million BTU for natural gas, and stay elevated through 2026 and then return to their historic levels. So that's the pricing scenario that we have built into our conflict scenario that we are suggesting would shave off 0.5% of growth in trade over 2026. Now, that could be understating or overstating, of course, the price effects of the conflict. Part of it depends on the duration of the conflict. Part of it also depends on whether oil and natural gas infrastructure are damaged. Even if the conflict ends relatively quickly, those infrastructure damages could have a lasting effect.
Yeah, the duration of this disruption, a key unknown right now. Good morning to you, Robert. We focus a lot when we talk about trade, we have done in recent years, on goods trade, but clearly services are traded as well. What assumptions are you making there with regards to Iran? Because I'm thinking about the role that the region plays, increasing role that the region plays in global tourism, for example.
That's exactly right. And services trade tends to be less variable over the years. It grew very quickly in 2025, and we're projecting that it will also grow slightly less quickly in 2026 in our scenario that does not incorporate the effects of the conflict. The effects of the conflict would shave, according to our predictions, about 0.7% of growth off of service trade, in part because, as you point out, the Middle East is a transportation hub and a tourism hub, and those services are very important in the global economy and could be directly impacted, of course, through the geography of the conflict.
Robert, stepping back from the Iran conflict, I wanted to ask you about the broader context for what we're seeing around global trade. We spoke yesterday to a Nobel Prize-winning economist from 2025, Philippe Aghion, who was talking to us about the role that trade plays, the evolving role that trade plays. Globalization was being driven by a search for lower-cost product initially, and now it's being driven by something else. Let's just have a listen to what he told us.
Cost minimization was the driving force of value chains. And nowadays, resilience is becoming much more a driving force of value chain. You want to make sure that you deal with countries that will not turn their back on you.
I wonder what you make of that kind of commentary, Robert, the fact that the nature of trade has changed a lot. It's not about necessarily just sourcing cheaper product, but it's about a resilient product and supply chain.
Yes, I think that is very true. And in our report, we do look at fragmentation across countries in trade, and we have seen in the past some rising in fragmentation. Countries, groups of countries trading more within their groups than between groups. Based on political beliefs, and that fragmentation plateaued for a bit, and now seems to be increasing again. And it is more related now to U.S.-China geopolitics. So there is, for sure, an element of geopolitics that is impacting the shape of global trade. And one that makes the rules-based system that the WTO helps to administer all the more important to provide stability and predictability in this era.
And I know you've been looking at the role of AI in kind of driving the economy in 2025. What role does that play, do you think, in 2026, whether it's on the capex side or the productivity gains, and to what extent is it vulnerable to the energy shock that we're now seeing?
Very interesting question. Of course, as I mentioned, 2025 merchandise trade growth was unusually high relative to GDP growth, and a large part of the reason was because of the AI boom, AI investment boom that happened in North America, in Asia, and partly in Europe. And the reason that the AI boom had such an impact on imports and trade is that while investment generally is more intensive in imports. Investment in AI is extremely dependent on imports. So, for example, if you are looking at construction investment and you spend an extra dollar, usually 2 or 3 cents of that dollar will go to imported products. If you're looking at investment in AI enabling goods and products, when you put a dollar of that investment in, usually 70 to 80 to 90 cents of that go into imported products. So AI investment is very, very important for trade and imports, and it therefore, things that affect AI investment are going to affect trade. Well, you've mentioned the elevated energy prices from the conflict, and that is certainly one thing that could affect AI, because AI investment is very energy intensive, and the price of energy is an important input to the cost of AI investment. So that could either crimp the ongoing boom in AI investment globally, but it could also change the geography of where firms decide to invest in their data centers and other things, to look for countries and economies where energy costs are relatively low, either because they're using alternative energy sources, or because of local market conditions for natural gas, for example.
Robert, thank you very much. A nice link into our next conversation. Robert Straiger, Chief Economist at the World Trade Organization. Now, with oil and European natural gas futures surging since the start of the war in Iran, several analysts note that while the conflict is bad for the global economy, it hasn't sparked necessarily the same style crisis as in 2022. Depends on which assets you're looking at, depends on which geography. But let's talk about this now in a little bit more detail. Joining me now is Kesavartini Savarimuthu, who joins us from Bloomberg NEF, talks about the European power markets there. Really good to have you with us. Thank you so much for joining us, Kesavartini. So let's think about the parallels of 2022 and where they exist and where they break down. How do you approach that question?
Yeah, so today Europe is a little bit more resilient than it was 5 years ago. And it boils down to two main factors, right? Today we have a lot more renewables in the system and lesser power demand. So that reduces our reliance on natural gas to produce electricity. When we look at renewables alone, compared to 5 years ago, we've been tracking renewable capacity addition in Europe, and we have more than doubled renewables capacity today. We're at around 650 gigawatts in Europe, and that is more than double where we were compared to levels in 2022. So lots more renewables in the power system means we rely lesser on gas to produce electricity. The other part of the story here, and one a big driver, is also power demand reduction. So we've seen structural demand reduction since 2022, and this could be attributed to factors like installing more rooftop solar, and also a lot of energy intensive industries have relocated, and adoption of energy efficiency measures. So all of these have contributed to lower power demand. So we have a combination where we have more cheaper sources of solar and wind in the power system, coupled with lower power demand, which reduces the need for gas. So from that perspective, we are slightly more resilient today than where we were.
That's really interesting. It sounds like so more resilience and progress has been made. What are the remaining vulnerabilities for Europe?
So we are more resilient, but we are not independent, right? So we have managed to diversify our gas supply source. We used to be dependent on Russian pipeline gas for about 40% of our European gas supply. Now that has dropped to around 6%. However, that portion is now supplied by LNG. And that doesn't lead to us consuming gas overall in a lesser manner. It just means that we have diversified our supply source. And when it comes to LNG, if the price is right, Europe will attract the cargoes. So from that perspective, we do have markets that are more reliant on gas. For example, Italy is a prime example. It relies on gas for power generation more than other markets. And we still need gas power generation when we have dark winter days and we have low wind speeds. Gas power generators still are needed to ramp up to produce supply.
OK, thank you so much. Thanks for bringing us the analysis. Kesavartini Savarimuthu joining us there, European Power Markets team at Bloomberg NEF. Tom.
OK, coming up, we're going to talk to Harriet Reeves, Chief Information Officer at Starling, as the bank launches the first ever AI personal bank, as someone who also sits at the heart of conversations at the BOE and the UK government as well in terms of how to integrate AI solutions across the financial services space. So an interesting conversation coming up. Stay with us. This is Bloomberg. Welcome back. Now, UK Chancellor Rachel Reeves says she wants the UK to be the G7's fastest AI adopter. While the US has led the world in developing AI, surveys suggest the UK lags only France in terms of adopting it, with 39% of the working age population using generative AI tools, according to the latest data. And it appears Starling Bank got the memo. They've just launched Starling Assistant, which they say is the first ever AI personal banker. Harriet Reeves, Chief Information Officer at Starling Bank and co-chair of the Bank of England's AI Task Force, joins us now. Harriet, and we want to get your views on how the BOE is thinking about this, how the UK government is thinking about AI adoption. But let's start with this AI agentic assistant then. What exactly is it? What does it actually do?
Yeah, it's a really exciting time for us at Starling. So up until now, generative AI has been used primarily to serve information or guidance to consumers in the financial services space. But with the Starling Assistant, we're moving beyond that. And this tool can actually take actions on behalf of the customer. So you might want to set up a new payee, you might want to move money around your account, you might want to cancel your card. And all you need to do now is tell the agent that via voice or in natural language text, and that action will be carried out for you.
You can do this via voice. Do you think, so presumably you think customers are going to embrace this? Do you think it leads to further customer acquisition for Starling? And how do you address concerns about security and fraud?
Yeah, so at Starling, we've always been about using the latest technology to pioneer what banking experiences can look like for consumers. And using agentic AI is no different. We really see this as the beginning of a new era for experiences, and we'd like to show customers that AI can help them to manage their money by being more proactive about the actions that they take. When it comes to the security and the fraud aspect, of course there are risks here, and that's why we've been in pilot and testing with staff and customers for about 9 months. That's got us to the point where we're really comfortable that we can put these technologies into the hands of customers, and we're really excited to see how customers get on with them.
Yeah, Harriet, it sounds like you're very excited. The whole sector, no doubt, is moving in this direction. But, you know, speaking for a friend, if I'm a person who hasn't even used an agent to book a table at a restaurant yet, do I really want to rely on it to do banking? I mean, what's the appetite for this kind of product amongst customers?
Curiously, from our consumer testing, we found something really unexpected. We thought that it was going to be all the young tech-native people that were going to love this tool, and that we might struggle to convince some of the people that were less tech-savvy to use it. But it was actually the opposite. Customers found the ease of being able to simply ask an agent to carry out an action, and then be able to see within their banking app that that's being carried out as they requested, to be something that they found very heartening and very empowering.
Yeah, I mean, you're a relatively new business, and I mean, a lot of bigger banks have loads of legacy systems that sort of talk to each other with different degrees of success. How easy has it been to introduce something into Starling? How would you say the sector is going to be able to introduce this kind of AI tech?
For sure. So at Starling, this tool is the culmination of about 8 years of machine learning and AI development and research. So it's been a long time coming, but of course there have been many incremental and iterative steps on the way. I think for the industry, for sure, siloed data stacks and legacy technology are going to play a part. But I'm starting to see lots of movement in the industry, and in my AI champion role, I'm really excited to see firms embracing what AI can bring, both in the back office and starting to see in the front office too.
What would you ask the government to do? If there's one thing the government could do right now to accelerate this kind of innovation and adoption, what would it be?
So at the moment, the government has appointed financial service champions, as myself, simply to get in there and understand what the barriers are for consumer banks. What we're understanding is that there's some inconsistency around the comprehension of regulation in UK financial services. So there's obviously more we can do to make sure that firms comprehensively and consistently understand that. And then we need to think about the longer term of how we use UK infrastructure to support the AI development in the financial services sector and the wider sector and industry here in the UK.
There are a number of things coming into play here, aren't there? Because there's, yes, the UK government's push into AI, the banking sector to some degree embracing that, and we're talking about that this morning. The government's also wrestling with technological sovereignty, though, and questions around that. And I wonder where we are on that in that conversation, because the UK relies on a lot of compute from abroad, a lot of cloud storage from abroad, not to mention the actual AI technology. What's the progress being made on that front?
Yeah, so I think absolutely everyone can see that our move into AI right now, whilst we are accelerated, particularly in the financial services sector, is reliant on US technology. And so we as a country do need to think about what our strategy is moving forward to remove that complete reliance on the US and perhaps to mitigate it with other relationships on the global stage or with our own sovereign strategy. Of course, the UK AI strategy tackles that. But I think there's more we can do, and I'm excited to be part of that.
There was a story, our own team reported out the story around HSBC and potentially massive cuts to the workforce that they're thinking about in the years ahead as they adopt AI. That is the risk, isn't it? We adopt AI, jobs in the banking space go.
Of course, I think there's an obvious productivity and efficiency gain when it comes to AI technology, and it's good to see banks embracing the spirit of what AI can bring in the back office. But I think it's a real shame if that's all we talk about when it comes to the power of this technology. There is so much more that AI can bring. Just like 10 years ago, none of us did our banking on a banking app. In a few years' time, not now from now, we might be asking, how did I do my banking without AI?
Harriet, thank you very much. Thanks for joining us. Harriet Reeves, Chief Information Officer at Starling Bank. 8:55 here in London, Tom, and typically at this time of a Friday, our thoughts turn to, sport, it seems, for this weekend. It's nothing but sport,
finally,
is that right?
After this week. Well, there's a little bit more than sport, but let's see what else is on the docket then for this weekend to keep you entertained. So, you've got the NCAA March Madness begins. You've got the EFL, of course, Cup final. Arsenal, Manchester City. Good luck, Arsenal. Real Madrid, Atletico Madrid. That's going to be epic, isn't it? The two historic rivals, of course. The Miami Open begins, tennis. And this is Anna Edwards' favourites. It's the comeback of BTS. Anna's going to be tuning in. This is
it takes place, my understanding, it takes place in Seoul, but there's going to be some sort of global live streaming event.
Don't pretend that you haven't already bookmarked this.
Yeah, I've not really done a deep dive into this subject this morning. I got rather distracted. In fact, they've given an interview to Bloomberg Business Week, so I got rather distracted by the content of that. But anyway, interesting to see them back. They were such a force in terms of Korean pop culture, and taking it global became something of an obsession.
So Anna Edwards is going to be at least half of the 82-date world tour, so they got set up. The free concert in Seoul, so 82 dates, 250,000 in-person fans on Saturday, streamed on Netflix to more than 190 countries. They could be generating just $1 billion in revenue, just $1 billion when it wraps up in 2027.
OK, and if that's not enough for your weekend, of course, you can catch Bloomberg Weekend. The TV channel over the weekend is now live and available to you. There's also a newsletter. We bring you a collection of interviews, ideas, stories that explore the fascinating places where finance, life and culture meet that might or might not feature BTS and all things to do with Korean culture. That is it for the opening trade. The Postal's up next, 8:56 here in London. This is Bloomberg.